Hey traders, this is Blake Morrow with Trader Summit, and it is Friday. I've got Jim Welsh from Macro Tides with us, and Jim, he's here to break down all these crazy moves that we've seen at the end of the quarter, end of the month, end of the first half of the year. What a wild market we've seen this week, huh, Jim?
Oh yeah, it is. I mean, the volatility is spreading, in terms of it's engulfing more and more of the markets, which again is, I think, somewhat typical when you get monetary policy, not just in the US, but globally, shifting to a tighter framework. And I think the markets are somewhat concerned that at some point in time, is something going to break, which I think that fear alone is maybe contributing to some of the volatility we've seen.
Yeah, I think it is, and as traders, we welcome volatility to a point.
Well, I'm not going to remember her name. I should remember a long time ago. Too much of a good thing is better.
Yeah, all right.
It was a blonde from the 1930s. I can't remember. I'll remember it after we finish. But anyway,
of course you will, and I'm sure somebody will.
Financial markets, too much volatility is not a good thing.
Yeah, and speaking of which, if you guys and gals have any comments that you want to bring to Jim or myself, make sure you jump in the comments section below. If you're watching us on YouTube, make sure you give Jim a thumbs up, subscribe to the channel so you don't miss any of his exclusive content that he does here on Trader Summit. Jim, we got a lot of things to talk about, a lot of things to dissect this month, or this month, excuse me, this week. A lot of activity, but you brought some specific charts to talk about. And the first one that you wanted to start with was really the let me make sure I've got that correct. The Treasury's worst start of the year. And I wanted to go ahead and show everybody what you're discussing or what you brought, and maybe you can talk to everybody about what you're seeing.
Yeah. So basically what we're going to be talking about is the change in financial conditions. And contributing to that are things like the bond yields, stock market, strength in the dollar, credit spreads, and so forth. So, what we're going to see in a second is that financial conditions have increased rather significantly. And one of the primary contributors is what's been happening in the Treasury market. And what you can see is for the first 5 months of this year, it's the worst start to since 1788. And I love charts that go back this far because they're kind of mind-blowing in a way, and they're so cool to see. But it underscores that what's happened in the Treasury market is truly historic.
And so, Jim, what do you make of that? Because I think back for my 25 plus year career in the markets, I've always known as a trader and an investor in the markets, when things get rough, people turn to they turn to treasuries, they turn to the bond market, and most portfolios that you see out there are balanced between equities and bonds. But really, you've gotten hit both ways, and almost every way. And I'm sure I'm talking to some of you at home in your portfolios. You're like, yeah, my bond, my bond holders have not done. They've not helped. They've actually just, worsened. So, what do you make of that?
Well, a couple of things. First of all, we talked, occasionally over the last month or so that the majority of financial advisors, people who are running money, they've been running money for 25, 30 years. They're 45, 50 years old, maybe. They've never encountered 40-year highs in inflation. And so I think that has caused and led a lot of people to misjudge what the Fed was likely to be doing and the impact from a central bank that's actually serious about reining in inflation. And obviously, bonds doing what they're doing is a component of that. The other aspect, I would say, Blake, is in 2001 to 3, when the market was down about 49%, 2000, obviously the financial crisis, 7 to 9, the S&P is down 57%. Well, Treasury yields did, they came down, bonds rallied. So those who have been in the business 20 to 25 years, their experiences is, when the market takes on water, the bond market is going to provide ballast.
Yeah.
Now, I wrote about this in June of last year, June of 2021. And if somebody would like to receive a copy of that, send me an email, jimwelshmacro@gmail.com. I'll send it to you. And what I pointed out, Blake, was if you go from like the 40s to 50s, 60s, and 70s, what happened is bonds and stocks went up and down together in terms of bond prices. So the correlation has always been very positive in terms of stocks go down. Yeah, in part because bonds are going down. The anomaly was the last 20 years where they had this inverse relationship. And what I put forward in June of last year was that is likely to change. We're going to see bond prices go down and stock prices go down together. So that traditional 60-40 mix wasn't going to help. And as it turned out this year, I think it's the worst so far performance-wise for anybody with a 60-40 in decades.
Amazing,
so
right?
It's not a complete surprise, because I just thought that the historic relationship with Treasury yields so low and inflation likely to pick up, that we were going to see the relationship between bonds and stocks revert back to what they had been prior to 2000.
Well, let's talk about financial conditions. The next chart you brought here is the fastest tightening in the last 7 cycles. Explain this chart and what you're seeing and why it's important.
So at the bottom axis, you see 0. And that is the number, like, okay, the clock starts to tick. When did the Fed raise rates for the first time in a hiking cycle? And this includes a total of 7 cycles, all the way back to 1984. And what we can see is in about 13 weeks, because the Fed raised the funds rate at the mid-March meeting, it is risen way more in terms of financial conditions tightening than any of these other cycles. So what that means in the real world is that even though the Fed hasn't raised the federal funds rate a whole lot, financial markets have done a lot of work. There's an expression, don't skate to where the puck is, skate to where it's going to be. And what we've seen is things like the 2-year yield go from a very low level late last year. All of a sudden, a few weeks ago, it was at 345 or something. And the Fed funds is way, way below it. So this tightening of financial conditions, I think potentially could impact how quickly the economy responds. Historically, the relationship, hey, when the Fed does something, easing or tightening, it's about 6 months lag time before the economy really feels the full impact of it. Well, because financial conditions have tightened so rapidly and significantly, I think that lead time is likely to be less. So that instead of thinking, gee, by early next year, the economy is going to show the wear and tear, I think it's going to happen much sooner. And as a result, that could have a bearing on how the Fed responds, because they're aware of this stuff. What the Fed chooses to do, not at the July meeting. I still think they're going 75 in July. But I think as you get to the September, November meeting, I'm still in the camp that, I don't think we're going to get a recession, but the Fed is going to see enough slowing. We're going to see inflation start to come down, not rapidly. And it maybe opens the door for the Fed to downshift, potentially from 75 basis points in July, at least 50 in September, and maybe 25. We'll see. But this is the part, I guess for most people to understand, when the Fed conducts monetary policy, they change financial conditions. So this is the leverage that they have over the economy. So if they tighten, it's going to slow. And when they ease, financial conditions ease, and that, leads to recovery. So they've jammed on the brake. Well, they've, obviously stepped on the brakes. The financial markets have stepped on it even harder than the Fed.
You're one of the very few people, Jim, that I talk to that says that we are not going to be in a recession in 2022, or that we're not in a recession currently. So what makes you so confident to believe that we will not see you can call it technical recession, I guess. What makes you believe that we won't be in a technical recession?
Well, but there's a huge difference between a technical recession and a real recession.
Well, please explain.
First quarter was down. A lot of people are like, oh man, the Atlanta Fed now is negative, so we'll have 2 consecutive quarters. So we're in a technical recession. Okay, fine. That to me is mental masturbation. The reality was the first quarter was actually fairly strong. So let's look at the real world. Trade was so out of whack in the first quarter, subtracted more than 3 percentage points off of GDP. So they subtract that from GDP because that meant demand, domestic demand, wasn't fulfilled by domestic producers, but from international producers. But the key point here, Blake, is we're talking about aggregate demand. So if aggregate demand was so strong that not only did we pull, US consumption up, but we had to pull stuff in. That's not the kind of recession thing that really is real in the world that you and I live in, right? So I think, in April, I said, we're going to have a recession scare. That's what's coming at some point in time. I think we're here, and we're going to see earnings cut, and, which reinforces all that. And if we get a negative print, which I think won't come until like late July, the first estimate of second quarter GDP, there's going to be people blowing their minds up. Oh my God, we're in a technical recession. It's like, take a deep breath, okay? I don't think so, because consumers still have over $2 trillion worth of savings. Wages are growing rapidly. The labor market is still very, very strong. These are the things that sustain economic growth. And until we see a material change in the labor market, I think there's a reservoir of demand that's going to sustain the economy in the next 6 months. So I've never thought 2022. The risk is next year. And for me, one of the focal points is, does the Fed move appreciably above 2.5% on the funds rate? They get it above 3%, I'm going to join the recession camp.
All right.
But I don't want to go there.
Got it. All right. Well, the next chart you bring in is something that you briefly just discussed.
Yes.
You were bringing up wealth effect, and one of the reasons why the consumers continue to stay, I think, in the saddle is because, I would say losses in, unless you're dealing in crypto, losses on household balance sheets for the wealthier classes have been all right. I mean, equities have sold off a little bit. Housing seems like it's peaking. What are your thoughts with this negative wealth effect, and how's that going to influence your idea?
Yeah, I mean, if you look at the bottom 40%, they're getting squeezed from energy, rent, food costs, and now all of a sudden we've seen the losses in the equity market. So the S&P may be down a little over 20%, Blake, but the reality is a lot of stocks are down a lot worse than that. So my point is, you have to think about the math here. So the stock market as a percent of GDP was at like 175, 180% of GDP. So valuation was really, really stretched. So some of this is these mega cap stocks that have gotten hit. So they're contributing significantly to this drop in as a percent of GDP in the equity market. But it will have an impact on, I think, the upper end, the upper 50%, because those are the folks that have exposure to the equity market. And again, this is one of the reasons why I believe the equity or the economy is going to slow. I just don't think it's enough to crater the economy. As long as you have a healthy labor market, people still do have a fair amount of savings. They are going to turn more cautious because they're being told a recession is right around the corner. Well, if you keep hearing that, what do you do with your spending? You cut back a little bit. So I think all these things are going to come together to bring economic growth lower, but that is going to move the ball toward where the Fed wants to be.
That makes a lot of sense. All right. Well, the next chart you brought up, Jim, is TLT. So what do you make of this chart here?
Well, back you see where the green arrow is in mid-June. Technically, I thought that TLT had from a high of 155 declined in 5 waves. So we were finishing a declining phase in TLT, and I expected a rally that would get up towards 119, which is wave 4 of lesser degree, and potentially 125, which is about the 382 retracement of the decline from 155 to 108. So this morning we had a nice spike up, and it has pulled back, and it could be a little tricky here in the short term. The initial rally, Blake, went from 108 to 115, $7. You add $7 to 110.85, and you're at what, 117.85, and we got to 117.59. It's possible that this is just a bigger ABC, and we'll have at least a decent sized pullback before another leg higher. So I have thought that as the economy slowed and we got more evidence of it, that Treasury yields would come down, and they have come down very significantly. I think it looks like we're due for a little bit of a pullback, but I still think that 119 target is realistic.
So you still think we can make it up here? All right.
Yeah, I mean, I think a stop at 115 on this, maybe a touch lower, just to preserve. I mean, I recommended it when it was at 110. I sent out a special update. So, I think there's enough potential risk, given everything that's going on, that raising a stop to about 115 makes sense.
All right. And you have been talking.
That's a nice trade.
Yeah, but it is a nice trade. And you've been talking us through it all like the last
Yeah.
several weeks. So very, very
Yeah.
good. The S&P.
Okay.
What do you make of this move? Because equities, I personally think we're trying to form some sort of bottom here. I know you in the past you thought we could go lower, but
Yep.
What do you make of it now?
Okay. Well, when we talked 2 weeks ago, again, going back to that green arrow, I thought we were going to see a rally from 3650 up towards 3850 to 3900. When we spoke last week, I think, well, there may be a little bit more left, maybe up to 3950. It got to 3946. So now we're at a point of options. That red horizontal trend line is, to me, a make or break point in terms of if the S&P gets below 3739, we're going to go to new lows, in my opinion. There is the potential, as long as we hold that line, that we could see another leg up in a C wave that would carry the S&P up to 4,000, maybe even 4,050. The first rally from 36 and change to 39 is a little over 300 points. I had 300 points to 37.39. That's where that target comes. So it's possible we could see, but the rally from 36.37 is clearly three waves. And we had this pullback. So it's, again, looking at it as A up, B down, C up. That's a corrective pattern. And it would imply another leg lower. So, somebody wants to be short-term in mind, trading in mind, you can be long as we hold 36.39. Again, we're at the beginning of a quarter, inflows of money and so forth. It could be supportive.
That's a great chart, great point. And I think as you pointed out, we're at a very pivotal area in the market.
Yeah.
Let's discuss gold, because gold had a gnarly breakdown below 1,800, probably stopping out a lot of people today below these lows. What do you make of this move?
Okay, from the high, you can see a 1-2. The low back in late May was a wave 3. I've looked at the rebound that we saw as 4, and I expected there would be a drop below 1792, which was that low of wave 3. Okay, we got it, dropped to 1785, I believe. So there's the potential that there's 5 waves down here from the high. There's a couple things that are a little hairy about it. The decline from the most recent high is clearly 3 waves. So that opens the door to, that might have been A for 4, we've done an ABC down, which would be a B wave. Well, that implies a rally back up towards 1867, 1900. All right. Or, hey, maybe we got 5 down and we're going to get a more significant rally. So to me, what I basically said, gold gets below 1792, it's worth buying. And the stop should be that trend line, which I believe is, call it 1760, 65-ish. I don't think that trend line should be taken out. So I think gold is going to rebound here, based on the price pattern, support, and, just sentiment. I mean, no one cares about gold.
Well, I think a lot of the gold bugs will be happy to hear you say that. You also brought the dollar. Here we are, the dollar, getting back to those previous highs here around 106.
Yeah.
So what do you make of this move?
My thought was that as long as the dollar held 103.80, you had to still respect the upside. That confirmation of a pullback would be achieved once it closed below 103.80. That's the smaller line above there. That one there. Again, going back to the low in this last January, to me, you can kind of count 1 up, 2, then you did a big 1, 2, 3, 4, 5 that peaked at the 105, that number at 105.74-ish. So that would be wave 3 potentially. That pullback was 4, and now we're going to go to another new high. And then
5 up here, somewhere above 105.
Yeah, I'm looking for, for a number of weeks, I've been looking for a high in the dollar. but you needed to see it take out a prior low to confirm it. And as we can see, it's been stair-stepping higher. It's higher highs, higher lows. So that's where trend analysis, I think, is so important. Just basic trend analysis. Also, the red 5-day exponential average versus the green 13-day exponential average, also is another confirming signal. When it breaks below and you break chart support, the odds are you're going lower. That hasn't happened.
Well, the last chart.
Still in the camp, Blake, that I'm looking for a high, and then we'll see a pullback to at least 101.50, and I think potentially ultimately, again, sometime later in the last half of this year, 99.5, 100.
Wow. All right. Well, that would be a hell of a drop in the dollar. But
yeah.
you brought the euro, and this is one of those currencies that is not following the dollar, the index, and it's over 50% of the index itself. So what are you going to do here with the euro? I mean, I admit that the euro is holding up pretty well in light of everything, but is there new lows ahead in the euro?
It's possible. I mean, when we spoke, a few weeks ago, when it got under 104, it's like, okay, buy it. And then when we talked a week or so later after that, 107.50, time to take some money off the table. Last week I said, hey, buy it on weakness as long as you hold the most recent low. I think it held it by about 8 cents, roughly. So again, I think the euro is going to rally to 107.50 to 108. I think we're going back there. Near term, you might see, like we just saw in gold. You take out those recent lows. Obviously, there's got to be a lot of stops in the euro underneath the recent lows. You take them out, you're going to see a spike down. So again, my bias is looking for a place to go long. That there could be a spike low that happens as the dollar makes one final higher high.
So let's give the old dollar a little hoo-yah, and let's see if we can get one more last rally out of it. Well, Jim,
hopefully we give the dollar a kiss goodbye.
Oh, and a kiss goodbye. All right. Well, I'll tell you, Jim, I always love meeting with you on the weekends or as we approach the weekend. I think it's great. It's great review, but also you have a great knack for letting us know what to be expecting. Anything big on your radar going into next week?
We have a 4th of July. No, next week, obviously Friday, the employment report is going to be really key because I think the Fed is really, that's the thing that they need to see start to, show slack. And so I would look at the JOLT survey, unfortunately, is a month old. So it's kind of worthless when you're at a transition. Indeed comes up with a more accurate or timely number. So I think we're going to need to see the number of job openings drop by 1 million to 2 million, because the Fed then knows that's starting the process of easing up the labor market. It's going to happen. I mean, if you're a businessman and you've been trying to find people, can't find people, and now you pick up the paper and almost every day the headline is, hey, a recession is coming. You were thinking about adding 8 people, maybe you only add 5. So that process is going to happen, and that's what the Fed wants to see.
Yeah, and that is undoubtedly with the news and the media, and it's kind of like just a self-fulfilling prophecy, if you will, at some point. You're going to have employers that are going to take notes. So, Jim, appreciate each of you every week. How do traders follow your work, and how do they get a hold of what you do at Macro Tides?
Okay, macrotides.com. You can find more information there. And as I said earlier, happy to send that research report I put out in June of last year regarding the correlation between bonds and stocks. Just send me an email, jimwelshmacro@gmail.com.
All right, and everybody, if you're enjoying what Jim does here every week, give him a thumbs up on YouTube. Thanks, Jim, for your time, as always, and spending it with the Trader Summit community. Have a great week next week.
Thank you, and happy 4th of July to you and all the other Americans that are tuning in.
Happy birthday, America. All right.
Thanks. Yes, thank you. That's a great way of putting it.
Hey, traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.